All right, let's dive into India's Goods and Services Tax, or GST. At the very heart of this whole system, there's one mechanism that makes it all tick. It's called input tax credit, and honestly, it's the backbone that stops you from paying tax on top of another tax. So today, we're going to break down exactly how this powerful tool works.
I mean, seriously, have you ever looked at a bill and just felt like you were paying tax on top of a tax? Well, before GST, that wasn't just a feeling, it was a huge problem. A product would get made and taxed. Then it goes to a wholesaler who pays tax on a price that already has that first tax baked in. This is what we call the tax on tax effect, or cascading taxes. And it just made everything way more expensive for you, the final customer.
Okay, so here's our game plan for today. We'll start by digging into that old tax on tax problem. Then we'll introduce the GST solution, which is input tax credit. After that, we'll see how the credit actually flows, cover the 4 golden rules you've got to know, and finally, we'll look at what you can't claim. Let's get into it. All right, Section 1, the tax on tax problem. So how do you even begin to fix a system that just keeps taxing the same value over and over again? Well, you change the entire game. GST was specifically designed to tax only one thing, the new value that's added at each and every step of a product's journey, from the factory all the way to you. And this quote really nails it. GST is nothing but a value-added tax on goods and services combined. See, it's not just another tax slapped on top of everything. It's a complete shift in thinking. The whole point is to get rid of that unfair pileup of taxes and make the final price you pay way more transparent and, well, logical.
Okay, Section 2, ITC, the GST solution. So how does GST actually pull this off? Well, it has a secret weapon. And this is where we introduce the real hero of our story, input tax credit, or ITC for short. This is the mechanism that finally puts an end to that whole tax-on-tax nightmare and makes a true value-added system a reality.
So what exactly is input tax credit? Simply put, it's the tax you already paid on your business purchases that you can then use to lower the tax you owe on your sales. Think of it like this. It's basically an instant rebate for the GST you paid on your business inputs. Things like raw materials, services, whatever. You get this credit, and then you use it to offset the GST you have to pay on the stuff you sell. Pretty cool, right? And honestly, calling ITC the backbone of the GST regime is no exaggeration at all. I mean, if you took ITC away, the entire GST system would just crumble. It would go right back to that old, broken, cascading tax model in a heartbeat. ITC is literally what keeps the whole thing running smoothly, efficiently, and transparently.
Okay, Section 3, how credit actually flows. So we've talked about the theory, but how does this credit actually move through a real supply chain to stop that double taxation? Let's get practical and follow the money with a simple example. Okay, let's trace this out. First up, the manufacturer. They start with 100 rupees of raw materials and make a product they sell for 150. So the value they added is 50 rupees. And that means they only pay GST on that 50 rupees. Simple enough? Now the wholesaler buys it for 150. But here's the key. They get to claim the tax the manufacturer already paid as a credit. So when they sell it for 200, they've also added 50 rupees of value, and they also only pay GST on their 50 rupees. You see the pattern here? It's the same for the retailer. At every single stage, the tax is only paid on the new value created. That right there is the magic of ITC in action.
All right, Section 4, the 4 golden rules. So ITC is obviously super powerful, but it's not a free-for-all. You can't just claim it whenever you want. It's a right that comes with some very clear responsibilities. So let's get into the 4 golden rules from the GST Act that you absolutely, positively have to follow to claim your credit. Think of these 4 conditions as the gatekeepers for claiming ITC. Number 1, you have to have a proper tax invoice. Simple as that. No invoice, no credit. Number 2, you have to have actually received the goods or services. You can't claim it for something that's still on its way. 3, and this one is so important, your supplier has to have paid the tax they collected from you to the government. And finally, number 4, you must have filed your own GST return. You've got to hit all 4 of these. It's not a pick-and-choose situation. Now, let's really focus on that 3rd rule, because it's a huge deal. Here's the crucial point. If your supplier doesn't pay the GST they collected from you to the government, your credit can be denied. Think about that. They charge you the tax, you pay them, but if they don't pass it on to the government, the system flags it and your claim gets rejected. Suddenly, you're the one out of pocket. This is exactly why who you do business with matters so much. It's not just good practice, it's critical for your own financial health.
And there's another time limit you need to know about. 180 days. You have to pay your supplier's invoice, the whole thing, including the tax, within 180 days. If you don't, you have to reverse any ITC you've already claimed on that purchase. Now, you can get it back later once you finally pay, but trust me, it's a huge compliance headache that you really, really want to avoid.
Okay, what about big ticket items like capital goods, a new machine for the factory, for instance? Here, you have to make a choice. It's called the no double benefit rule, which means you get one tax break, not two. So you have to pick a lane. Option 1 is to claim ITC on the GST component right away. This gives you an immediate cash flow boost. But you can only claim depreciation on the base cost of the asset. Option 2 is to not claim ITC. Instead, you add the GST amount to the cost of the asset and then claim depreciation on the full amount over several years. You have to pick one path. You can't have it both ways.
All right, Section 5, what you can't claim. So as great as ITC is, it's not unlimited. The law draws some pretty firm lines in the sand about what you can and can't claim. So let's talk about the two big limitations you need to be aware of: apportionment and something called blocked credits.
So the idea here is actually pretty straightforward. You can only claim ITC on inputs that you use for taxable sales. That makes sense, right? This includes your normal sales and also zero-rated sales like exports. But if you use those same inputs to create a product or service that is exempt from GST, well, you can't claim any credit on that part. And what if an input is used for both? Then you should do some math. You have to apportion or split the credit and only claim the percentage that was used for your taxable sales.
Okay, so besides having to apportion credit, there's another category you need to know about: blocked credits. These are specific expenses where the law just says, nope, no ITC here. It doesn't matter if it was a legitimate business expense. For these specific items, the credit is just blocked, period.
So, what kind of things are on this blocked list? Well, here are some of the most common ones. A big one is motor vehicles. You generally can't claim ITC on a car, with some exceptions for, say, transport businesses. A lot of personal comfort expenses are also out, so no ITC on food, beverages, or that gym membership for the office. Most construction services for building things are also blocked. And finally, if goods get lost, stolen, or you give them away as free samples, any ITC you might have claimed on them is gone.
So, let's bring it all together. The crucial takeaway is this: input tax credit is the absolute key to preventing that old double taxation problem. It's what makes GST work. But, and this is a big but, it's a right that comes with very clear rules and responsibilities. It's not automatic. You have to earn it by following the rules.
So, now that you know the rules, is your business actually making the most of its input tax credit? I mean, really think about it. Are you tracking your inputs, checking on your suppliers, and claiming every single rupee of credit you're entitled to? Because in the end, that's what it all comes down to.